Hello traders and welcome to today's Masterclass Explainer. I'm your stock market mentor and today we're diving deep into the very heartbeat of the market, and that is psychology. Whether you're a complete beginner, a seasoned intraday trader, or you're playing with futures and options, this lesson is absolutely for you. We're going to decode the mindset of retail traders versus the big market players and learn how you can start trading with real professional discipline.
Now tell me, have you ever wondered about this? You open your chart, you spot a massive green breakout candle, you execute your buy order with full confidence, and immediately, bam, a red candle appears from nowhere and hits your stop loss. It honestly feels like someone is sitting there intentionally hunting your positions, right? Did you know roughly 80% of retail breakouts actually fail? Well, today we're going to uncover exactly why the market seems to reverse the exact second you decide to enter.
So here is our mentor's blueprint for today. We will cover retail traders versus the big bulls, then the stop-loss trap, understanding market structure, the retest strategy, and finally, professional risk management. Let's get right to it.
Before we jump in, let's establish a very important foundational reality check. The stock market is made up of many diverse participants. We've got retail traders, institutions, hedge funds, banks, market makers, and long-term investors. No single participant controls the market all the time. Today, we're discussing common market behaviors and probabilities. We're looking at how different groups think and operate. We are definitely not talking about guaranteed manipulation or wild conspiracy theories here. We're simply studying how high-volume trading impacts price discovery.
Section 1. Retail traders versus the big bulls.
Let's understand the players in this ecosystem. On one side, we have the scattered school of retail fish. These are everyday people making smaller trades, usually trying to capture very short-term price movements. On the exact opposite side, we have the smart money, the big bulls, the absolute sharks of the market. In our Indian markets, these are your FIIs and DIIs, the foreign and domestic institutional investors. See, because their orders are in hundreds of crores, they can't just casually click buy without violently shaking the price. They are constantly hunting for liquidity. They need enough opposing orders to fill their massive positions. They aren't necessarily targeting your individual trade, they just need the volume.
And the mindset difference between these two is huge. The retail trader is heavily driven by emotions, fear, greed, hope, and pure panic. They suffer from intense FOMO, the fear of missing out, so they chase a fast green candle like they're trying to catch a moving local train at the last second. They enter late, they book their profits way too early, and they hold on to losing trades purely on hope. But the big bulls, the complete opposite. They focus strictly on execution quality and position sizing. They do not chase, they patiently wait for the market to come to their specific zones of liquidity using very sophisticated strategies.
Section 2. The stop-loss trap. Let's see how liquidity hunting actually works.
You have to realize that big players understand technical analysis just as well as you do, probably better. And they know exactly where retail traders are placing their targets and their stop losses. Remember what we just said? Institutions trade in massive quantities, which drastically increases market volume. To buy a huge amount of stock, they literally need a huge amount of sellers. To sell a huge amount, they need buyers. And where do they find a nice big cluster of matching orders? Right at the obvious support and resistance levels. That's exactly where retailers place their stop losses. When those stop losses hit, it creates a flood of liquidity, and the big players use that exact flood to seamlessly execute their own massive trades.
Let's picture this. Imagine an uptrend pushing higher and higher. It eventually reaches a point where the real buying momentum dries up, but a breakout is beautifully engineered on the chart. Retailers see this breakout, their FOMO kicks in, and they aggressively buy in with fresh orders. What they don't realize is the market is already in an overbought state, right at a major resistance zone. The moment these retailers jump in late, they provide fresh liquidity. And what happens? The smart money sellers instantly dump their massive positions into those retail buy orders. The price immediately reverses from the top, sweeping out all those retail stop losses that were placed just below the breakout candle. It's a classic trap.
Section 3. Understanding market structure. This is your defense.
Knowing market structure is the absolute foundation of successful trading. By definition, it's the simplest form of price movement based on basic support and resistance levels, swing highs, swing lows, and liquidity. Understanding this blueprint is what actually allows you to determine the overall trend. Is it a bull trend making higher highs? Is it a bear trend making lower lows? Or is it just a sideways, ranging market? Without knowing this basic structure, honestly, you are just guessing in the dark.
Now, when you're looking at a chart and you see massive, straight green candles shooting vertically upward, that right there is direct buying pressure. It looks incredibly tempting to a retail trader experiencing that fear of missing out. But listen carefully, unnatural vertical buying pressure almost never sustains for a long time. It collapses just as fast as it rose, instantly trapping anyone who is foolish enough to chase the top in huge losses.
And this brings us to knowing the critical difference between a bad trend and a good trend. A bad trend is just a straight vertical line. It's emotionally driven, it's totally unsustainable, and it's ripe for a violent reversal. A good trend, however, moves in a very structured, stair-step fashion. It creates a higher high and then it pulls back to create a higher low. This pullback is essential. It builds a healthy foundation and gives professional traders a logical, safe place to enter based on structure rather than pure emotion.
Section 4. The retest strategy.
So, when a trend line breaks, it is rarely a good idea to just enter immediately. Why is that? Because those lower swing areas often act as strong support, and the market can very easily fake you out. Instead, we have to wait for confirmation. There are two primary methods for catching a solid retest. The first is when the price breaks out and then comes right back to perfectly retest the trend line itself. The second method is when the price breaks a lower swing point and then pulls back up to retest that exact same broken swing level.
Here is the real anatomy of this setup. We identify the breakdown, but we do not panic sell. We sit on our hands and wait patiently for the price to pull back up. That's the retest, which signals that previous support is now acting as resistance. We enter right there with a tight, logical stop loss, and we set our targets at the previous lower swings. Listen to this. Simply waiting for this exact confirmation can yield an incredible 80 to 90% accuracy rate. This, my friends, is exactly how you trade alongside the big bulls, not against them.
A disciplined trader's mind functions essentially like a checklist. Before they ever click execute, they ask themselves, what is the overall trend? Where are my clear support and resistance zones? Where might the big players be hunting for liquidity? Where exactly is my stop loss going to be? Is my risk-reward ratio actually acceptable? And most importantly, am I following my trading plan? Ask yourself, do you ask these logical questions before entering a trade? Or do you only ask them after you're already panicking in a big loss?
Section 5. Professional Risk Management.
Let's look at a concrete 6-step checklist taken directly from our source material. This will anchor your trading plan going forward. Step 1. Identify the trend by looking for those higher highs and higher lows. Step 2. Set logical entry points, like the retest we just talked about. Step 3. Set a strict stop loss based entirely on the risk your capital can handle. Step 4. Define your take-profit target before you even enter the trade. Step 5. Manage your position dynamically, like gently trailing your stop loss as the trade moves in your favor. And Step 6. Exit the position without hesitation when your target is hit or your stop is triggered.
Let's just remind ourselves of the ultimate difference between the retail fish and the smart money shark. Emotion simply reacts. A reactive trader engages in revenge trading immediately after a loss. They stubbornly move their stop losses wider to avoid taking a hit, and they end up overtrading purely out of boredom. Discipline, however, waits. A professional trader's primary #1 goal is protecting their capital. They fully accept small losses as a normal business expense. They don't try to avoid every single loss. Rather, they think in terms of long-term probabilities, ruthlessly avoiding emotional mistakes.
I want to leave you with this incredibly powerful summary thought. I want you to remember this the very next time you open your charts. Sometimes, the best trade is no trade. Professional traders are extremely comfortable waiting. You see, the market is always going to present new opportunities tomorrow and the day after that. Your job isn't to try and catch every single move. Your job is to patiently wait for the high-probability setups that align perfectly with market structure and your own personal plan.
So, I have a final challenge for you before your next chart session. Will your next trade be blindly driven by the fear of missing out on a fast green candle? Or will you channel the mindset of the big bulls, read the structure, and patiently wait for the retest? The choice is entirely yours. Keep learning, always protect your capital, and I will see you in the next explainer.